Chapter 7, we are going to discuss characteristics, valuation, and issuance of common stock. The column YTD percentage change represents the percentage price change for the calendar year to date. The column YOD percentage represents the dividend yield calculated by the annual dividend divided by the closing price. The symbol DD under the P ratio means loss in last 12 months, and the symbol CC under the P ratio means the P ratio is greater than 99. From the perspective of security holders, common stock is a variable income security because security holders do not get promised fixed payments in return for their investment. Common stock is a residual earning form of ownership because the claims of common stockholders are considered only after the claims of government, debt holders, and preferred stockholders have been met. Common stock is considered a permanent form of long-term financing because it has no maturity date. Common stockholders have a number of general rights including dividend rights, asset rights, preemptive rights, and voting rights. A firm may create more than one class of common stock for various purposes. For example, a firm may create separate class of common stock with unequal voting rights when selling a portion of the existing owner's stock to raise capital while maintaining the control of the firm. A stock split is a corporate action that increases the number of its outstanding shares by dividing each share, which in turn diminishes its share price. For example, a stock split of 2-for-1 means each shareholder receives an additional share for each share held, but the value of each share is reduced by half. A firm is more likely to declare a stock split to attract more buyers if the management feels that its share price is above the optimum range. Most investors view stock splits as an indication of good financial health of a firm. Therefore, the capital market tends to respond to a firm's announcement of stock splits positively. A reverse stock split is a corporate action in which a company reduces the total number of its outstanding shares by grouping more than one shares into one share, which in turn increases its share price. For example, a reverse stock split of 1-for-10 means every 10 shares are grouped into one share. A reverse stock splits are used to bring low-priced shares up to more desirable trading levels. Many investors view reverse stock splits as an indication of poor financial health of a firm. Therefore, the capital market tends to respond to a firm's announcement of reverse stock splits negatively. Stock dividends is a dividend payment made in the form of additional share rather than a cash payout. Stock repurchase is a program by which a company buys back its own shares from the marketplace, reducing the number of outstanding shares. The company can buy back shares directly from the market or offer its shareholders the option to tender their shares directly to the company at a fixed price. There are a number of reasons that a company may decide to undertake the share repurchase program, including disposition of excess cash, financial restructuring, future corporate needs, and reduction of takeover risk. From the company's perspective, one of the major advantages of common stock financing is that no fixed dividend obligation exists. In addition, common stock financing could reduce the financial leverage. From the company's perspective, disadvantages of common stock financing include it is riskier and involves higher cost than the long-term debt financing. Earnings per share may be diluted due to increases in the number of shares outstanding. The issuance cost associated with common stock is high. Now, from slide 11 to slide 18, the security offering process of a firm is discussed. They are all descriptive materials, so we are not going to go over them in this review session. Email me if you have questions about these materials. How are common stocks valued? You plan to purchase a share of stock and sell in 1 year, and you would like to determine how much you are willing to pay today. You forecast that a share will be worth $75 after a year, and you expect a $3.40 dividend after a year. The required rate of return is 12%. Not surprisingly, the price of the share should be the present value of the expected cash flows. That is, we discount the dividend received 1 year later and the share price 1 year later at the appropriate discount rate, which is the required rate of return, equal to $3.40 divided by 1 plus 12% plus $75 divided by 1 plus 12% equal to $70. We can apply our logic to price the share of stock a year from now, denoted by P1, based on forecasts of dividend and share price 2 years out, denoted by D2 and P2 respectively. Substituting the formula for P1 into the formula for P0 and simplifying, we get the formula showing that the current share price is composed of the present value of the dividend stream and the share price as of the end of year 2. We can extend our logic to cover any arbitrary number of time periods. Taking our logic to the limit, we see that the current share price is equal to the present value of stream of expected dividends into the indefinite future. What about firms that pay no dividends? It's covered by the word expected. In the limit, you could imagine a firm that never pays a dividend and reinvests all earnings. Then, at the end of time, the firm liquidates and pays one huge payment to shareholders. Our dividend valuation model still applies, and the share price is the discounted value of that one and only payment. The dividend valuation model shows that the value of a firm's common stock is a function of the expected future dividend stream and investors' required rate of return. Therefore, any financial decisions, such as investment decisions, financing decisions, and dividend policies that may impact expected future dividend payments and investors' required rate of return will eventually affect the share price. The main obstacle to implementing a general dividend valuation model is that we don't know what the dividend stream looks like. Economic theory provides no clue. 3 cases are commonly considered. Dividends are constant over time, that is, no growth. Dividends grow at a constant rate, that is, constant growth. Dividends grow at different rates for some periods, followed by a constant rate, that is, non-constant growth. The zero growth case is simply an application of the formula for the present value of a perpetuity. That is, the share price is calculated by the constant dividend divided by the investor's required rate of return. Practice problem. The phrase "for the foreseeable future" means indefinitely. This is a zero growth case. Therefore, the zero growth dividend valuation model is applied to solve the share price. The constant dividend is $1.50 and the required rate of return is 12%. Now, let us look at the constant growth case, in which a firm's future dividend payments per share are expected to grow at a constant rate g per period forever. Assuming the required rate of return Ke is larger than the constant dividend growth rate g, we arrive at the following formula. The current share price is calculated by the expected dividend next period divided by the required rate of return Ke minus the constant dividend growth rate g. Practice problem. This is a constant growth case, so we apply the constant growth dividend valuation model to solve the share price. We have the expected dividend next period, $2.20. We have the required rate of return, 10%. We have the constant dividend growth rate, 7.5%. We have taken the discount rate, that is the required rate of return Ke as given. We can also take the constant growth formula and the known stock price and solve for the required rate of return Ke. We arrive at the following formula. The required rate of return is equal to the expected dividend yield calculated by the expected dividend next period divided by the current share price plus the constant dividend growth rate G, also known as price appreciation yield. Practice problem. The sentence highlighted here indicates that this is a constant growth case, so we will apply the constant growth dividend valuation model to solve the share price. The sentence, during the past 10 years, Saturn's common stock dividends have grown from 24 cents to 62 cents, gives us the information about the current dividend D0, which is 62 cents, and the implicit constant dividend growth rate. The statement, an investor who requires an 18% rate of return, gives us the information about the required rate of return Ke. We know that the constant growth dividend valuation model should be used to solve the current share price P0, where the expected dividend next period D1 is equal to the current dividend D0 times 1 plus the constant dividend growth rate G. We have the current dividend D0 equal to 62 cents and the required rate of return Ke equal to 18%. We need to find out the constant dividend growth rate G before obtaining the current share price P0. We can find the dividend growth rate G by using the financial calculator. We can think of the problem as you deposit 24 cents and would expect to have 62 cents in your account balance 10 years later. What would be the annual rate of return earned? That is, given the number of investment periods, the present value, and the future value, we would like to solve the interest rate. We have the number of investment periods n equal to 10, the present value equal to 24 cents, a cash outflow. The future value equal to 62 cents, the payment equal to 0. Compute the interest rate. The interest rate obtained is the constant dividend growth G that would be used in this problem. We have all the information we need for implementing the formula. Plugging them into the formula, we can solve for the current share price P0. Another practice problem for the constant growth case. This problem is similar to the previous problem we just discussed. We have current dividend D0 equal to $2.50. We need to obtain the constant dividend growth rate G by using the dividend information provided here. That is, the dividend grew from $2.32 to $2.50 in 3 years. We can solve the constant dividend growth rate G by using the financial calculator. We will detail the steps in the next slide. The required rate of return is 18%. We can find the constant dividend growth rate G using the financial calculator by solving the interest rate. We can think of the problem as you deposit $2.32 and would expect to have $2.50 in your account balance 3 years later. What would be your annual interest rate earned? That is, given the number of investment periods, the present value, and the future value, you would like to solve the interest rate. We have the number of investment periods N equal to 3, the present value equal to $2.32, a cash outflow, the future value equal to $2.50, payment equal to 0, compute the interest rate. The interest rate obtained is the constant dividend growth rate G that would be used in this problem. Once we obtain all the information needed, we can simply apply the corresponding numbers into the formula to solve the current share price P0. What's the investor's required rate of return? We are required to solve the required rate of return KE and the sentence. The dividends are expected to grow at a constant rate 8% forever indicates that this problem is a constant growth case. The required rate of return formula for the constant growth dividend evaluation model is given here. We have D1 equal to 1, the current share price P0 equal to 25, the dividend growth rate G equal to 8%, plug in the information into the formula and solve for the required rate of return KE, we obtain the required rate of return KE equal to 12%. We next would like to discuss the valuation problem with finite holding period. This is a stock valuation problem. We are required to find the current share price, which is the present value of all expected future cash flows. If we draw the cash flow timeline, we find that the expected future cash flows for this problem are the expected dividend at the end of year 1, D1, the expected dividend at the end of year 2, D2, the expected dividend at the end of year 3, D3, and the share price at the end of year 3, P3. We do not have the information for D1, D2, and D3, but we do have the information for the current dividend, D0, equal to $1, and the dividend growth rate, G, equal to 8%. We can apply the formula presented here to obtain D1, D2, and D3. We have the information for P3, the price at the end of year 3, equal to $76, and the required rate of return KE equal to 12%. Once we obtain all the information needed, we can apply the formula to solve the current share price P0. We discount D1 for one period to get the present value of D1. Discount D2 for 2 periods to get the present value of D2. Discount D3 plus P3 for 3 periods to get the present value of D3 and P3, and sum them together to obtain the current share price equal to $56.90. Now, we can also use built-in cash flow worksheet function in TIBA2 Plus or TIBA2 Plus Professional to calculate the present value of all these three uneven future cash flows. We have C0 equal to 0, C01 equal to D1, C02 equal to D2, C03 equal to D3 plus P3, and the discount rate is 12%. Now, we want to show you how to calculate the current share price for the non-constant growth case. We can divide the calculation of the price of a stock having non-constant dividend growth rates into 3 steps described here. From the problem, we know that dividends grow at 12% per year from year 1 to year 5, and then at 6% per year into the foreseeable future. The investor's required rate of return is 15%. If we look at the cash flow timeline presented here, we find that we can actually reduce this sum of infinite series problem into a finite holding period problem. How? First, let us step forward to the end of year 5, that is, the end of the non-constant growth period, and look forward. We see that we actually have a constant dividend growth case, with the constant dividend growth rate being 6%. We can apply the constant growth dividend valuation model to obtain the price at the end of year 5. P5 is equal to D6 divided by the required rate of return, KE minus G, the dividend growth rate. Once we obtain P5, we can ignore all the expected future dividends starting from year 6 because we have already summarized those expected future cash flows into one equivalent value, P5. So, we can safely cut off cash flow timeline after the end of year 5. Our problem is then to find out the present value of all 5 expected future cash flows, which are D1, D2, D3, D4, and D5 plus P5. This slide summarizes the formula used to calculate the dividends, the price at the end of year 5, and the current share price. This slide illustrates how to use the information provided in the present value interest factor table to obtain the present value of this problem. Here, we provide you with the detailed steps of implementing built-in cash flow worksheet function in TIBA2 Plus or Plus Professional to calculate the present value of this problem. This is from the end of chapter questions, question number 9. Make sure you do read through the problem so you will know how to extract the information needed. I'm going to proceed to the slide with cash flow timeline presented to illustrate how to solve the problem. From the problem, we know that dividends grow at 15% per year from year 1 to year 3, at 7.5% per year from year 4 to year 6, and at 5% per year into the foreseeable future. By looking at the cash flow timeline presented here, we find that we can actually reduce this sum of infinite series problem into a finite holding period problem. How? First, step forward to the end of year 6, that is, the end of non-constant growth period, and look forward. We see that we actually have a constant dividend growth case with the constant dividend growth rate being 5%. We can apply the constant growth dividend valuation model to obtain the price at the end of year 6. P6 is equal to D7 divided by KE minus G. Once we obtain the price at the end of year 6, we can ignore all the expected future dividends starting from year 7 because we have summarized all the expected future cash flows into one equivalent value, P6. Therefore, we can safely cut off the cash flow timeline starting from year 7 after the end of year 6. Our problem then becomes to find out the present value of all expected 6 future cash flows, which are D1, D2, D3, D4, D5, and D6 plus P6. Here, we present you the detailed input values by implementing cash flow worksheet function in TIBA2 Plus or TIBA2 Plus Professional to obtain the present value. The end of chapter question number 13. This problem is exactly similar to the number question 9 we just illustrated, so we will not discuss this problem in detail here. We do provide you the detailed solutions. Make sure you do understand this particular problem and let me know if you have any questions. This is a pretty straightforward problem. What you will need to solve is to find out the present value of D1, D2, D3, and D4 plus P4. You have the information for D1 and P4. What you need to do is to find out D2, D3, and D4 using the dividend growth rate provided. Again, we provide you with the detailed implementing steps and the corresponding value by using the built-in cash flow worksheet function in TIBA2 Plus or Plus Professional to obtain the present value.